You've spent your life believing that to get rich, you need to chase the next hot stock, study endless financial reports, and outsmart the market at every turn. You've been told that wealth comes from clever trades, insider knowledge, or timing the perfect moment. But here's the truth few people will admit. None of that really matters. The real secret isn't complicated. It doesn't require a PhD in finance or decades of experience. In fact, if I had to start over today with nothing but what I know, I wouldn't buy a single individual stock. I wouldn't try to pick the next Apple, Coca-Cola, or Tesla. I wouldn't stress over market crashes or get caught up in every headline. Instead, I'd do something far simpler, something proven over decades. I'd invest in 3 straightforward ETFs and let time, patience, and the power of compound interest do all the heavy lifting. These 3 ETFs alone could quietly turn even modest savings into millions over the years, giving you financial freedom, security, and the peace of mind that most people chase their entire lives but never achieve. And the best part? You don't have to constantly watch the market, analyze trends, or guess who will win next. You just start, stay consistent, and let the system work for you. What most people never stop to ask is why this approach feels almost invisible in real time. The answer is simple and uncomfortable. Dividend-based wealth does not trigger dopamine. There is no dramatic moment, no viral screenshot, no overnight transformation. It works in silence, which is exactly why it keeps winning. Markets are emotional machines. They are driven by fear, greed, envy, and impatience. Dividend investing is engineered to exploit those emotions by refusing to participate in them. When prices fall and panic spreads, dividend-focused owners are not forced to act. They are paid to wait. This psychological edge is not accidental. It is structural. When your income depends on selling, you are always one bad market away from being cornered. When your income depends on ownership, volatility becomes noise instead of threat. This is why during market crashes, while others scramble to protect paper gains, his attention shifts to allocation. He is not asking how much value was lost on paper. He is asking which high-quality cash machines are temporarily mispriced. Historically, this pattern repeats with almost boring consistency. During the 1973-1974 bear market, the dot-com crash, the financial crisis of 2008, and even the pandemic-driven collapse in 2020, dividend-paying companies with durable business models continued to generate cash. Some paused increases, some held steady, but the system did not break. Contrast that with speculative growth companies. Many of them vanished entirely. No cash flow means no margin for error. This difference explains why he has always been skeptical of businesses that promise greatness tomorrow while bleeding today. Hope is not a strategy. Cash is. To understand how deeply this thinking runs, you have to look at how he evaluates businesses before buying a single share. He is not asking how fast revenue can grow. He is asking how predictable the cash flows are, how much capital is required to maintain operations, and whether management treats shareholders like partners or like sources of cheap funding. Dividends answer those questions in one move. A company that pays and grows dividends is forced to confront reality every quarter. It must generate real earnings. It must allocate capital responsibly. It must resist the temptation to chase every trend. This discipline compounds just like money does. One reason consumer staples dominate his portfolio is that they face an unusual test: repetition. These companies sell the same products over and over. That exposes weakness quickly. If a product loses relevance, sales decline fast. The ones that survive decades have earned their place through consistency, not hype. This is why brands matter more than technology in his framework. Technology changes. Habits endure. Another overlooked advantage of dividends is how they interact with inflation. While fixed income loses purchasing power over time, businesses with pricing power can raise prices, grow earnings, and increase dividends. This makes dividend growth a partial inflation hedge, something most people only realize after inflation erodes their savings. The compounding effect becomes especially brutal when dividends are reinvested during downturns. Shares acquired at lower prices generate higher future income. In effect, volatility accelerates long-term returns for disciplined owners. This is not theory. Academic research has shown that portfolios emphasizing dividend growth historically outperform broader markets on a risk-adjusted basis. Lower volatility, higher income, and competitive long-term returns. Not exciting, but devastatingly effective. The key insight here is that dividends change the investor's role. Instead of speculator, you become allocator. Instead of reacting, you direct. This shift also explains why he has always warned individual investors against frequent trading. Activity feels productive. It rarely is. Costs compound negatively just as returns compound positively. Taxes alone can destroy decades of compounding if assets are constantly turned over. Dividends, especially when qualified, are often taxed more efficiently than short-term gains. This quiet advantage rarely makes headlines, but it shows up unmistakably over long horizons. The genius of the system is that it scales. It works at $1,000 and at $100 billion. The rules do not change, only the numbers do. This is also why he rarely discusses excitement when talking about investing. Excitement is a signal that emotion is involved. Emotion introduces error. Dividends reduce the need for emotion because progress is tangible and recurring. And here is the part most people miss entirely. Dividends create optionality. Cash on hand allows action without urgency. It allows patience without paralysis. It allows boldness without recklessness. When a once-in-a-decade opportunity appears, those without cash are forced to sell something else, often at the worst possible time. Those with cash simply write the check. That is power. This is the context you need before even talking about specific companies. Without it, the examples look like stock tips. With it, they become case studies in system design. And that system is why the fortune grew not just large, but resilient. One of the most dangerous mistakes investors make is confusing dividend yield with dividend quality. A high yield looks attractive, especially to someone hungry for income, but yield alone tells you almost nothing about whether that income will survive. In fact, unusually high yields are often warning signs, not gifts. A company paying an 8% dividend is not automatically generous. It may be desperate. Yield rises when price falls, and price usually falls for a reason. Weak balance sheets, shrinking markets, poor management decisions, or structural decline all show up in yield before they show up in headlines. What actually matters is dividend growth. A modest yield that grows steadily will outperform a high yield that stagnates or collapses. This is not opinion, it is arithmetic. Take two hypothetical companies. One pays a 6% dividend that never grows. The other pays 2% but grows that dividend by 8% annually. After 10 years, the second company pays more income. After 20 years, it isn't even close. After 30 years, the first one looks like a rounding error. This is why the obsession with immediate income often backfires. Investors reach for yield because they want relief now, but they sacrifice the engine that creates abundance later. Dividend growth turns time into an ally. Flat dividends turn time into erosion. This principle is embedded in every great long-term holding. The most successful dividend investments did not start flashy. They started boring and became unstoppable. When he bought shares of a global beverage company decades ago, the yield was unremarkable. What mattered was that people kept buying the product, margins were strong, and capital requirements were low. That combination allowed profits to grow and dividends to follow. Decade after decade, the dividend increased, turning a modest initial income stream into a torrent. This is what people mean when they talk about yield on cost. It sounds abstract until you live it. Yield on cost measures your annual income relative to what you originally paid, not what the stock trades at today. Over long enough periods, this number becomes absurd. A stock bought at a 3% yield that grows dividends at 7% annually will produce a yield on cost of over 20% after 30 years. That means for every dollar originally invested, you receive 20 cents per year in cash while still owning the asset itself. At that point, price volatility stops mattering emotionally. Even large market drops feel irrelevant when income keeps rising. This emotional insulation is one of the most underrated advantages of dividend growth investing. And this is where most people sabotage themselves. They say they want long-term wealth, but they behave as if every year is a referendum on their intelligence. They check prices constantly. They compare returns obsessively. They chase what worked last year and abandon what didn't. Compounding does not reward impatience. It punishes it. Every unnecessary trade resets the clock. Every emotional decision injects friction. Every attempt to be clever costs more than it gains. This is why simplicity scales and complexity collapses. He understood this early, not because he was immune to emotion, but because he structured his behavior to minimize its impact. He surrounded himself with ideas that emphasized patience. He avoided environments that rewarded activity. He focused on ownership rather than prediction. Prediction is seductive because it feels like control. Ownership is powerful because it doesn't require it. This distinction explains why so many intelligent people underperform simple index strategies. Intelligence increases the temptation to interfere. The more someone knows, the more reasons they can invent to act. Most investors don't lose because they are wrong about the long term. They lose because they can't sit still long enough to be right. And this is where the ETF structure quietly solves a behavioral problem most people don't even realize they have. When you own an individual stock, every piece of news feels personal. Earnings misses feel like betrayal. Leadership changes feel ominous. Lawsuits feel catastrophic. The emotional load is heavy. When you own a diversified ETF, the noise is diluted. One company stumbles, another surges. The system absorbs shocks without demanding your attention. This reduces the impulse to react, which improves results without any increase in intelligence. It's not that ETFs are smarter. They are calmer. This calmness compounds just like money does. That's also why index investing is not lazy. It is disciplined. It acknowledges the limits of foresight and designs around them. It accepts that the future is uncertain and builds resilience instead of precision. Precision breaks. Resilience adapts. This philosophy is also why attempts to outsmart the market through constant tactical shifts usually fail. The market doesn't reward effort. It rewards endurance. People often ask whether innovation changes these rules. Whether technology, artificial intelligence, or globalization makes historical patterns irrelevant. The answer is uncomfortable. The tools change, human behavior doesn't. Fear still causes selling at bottoms. Greed still causes buying at tops. Narratives still distort judgment. Complexity still creates blind spots. If anything, modern markets amplify these tendencies. Information moves faster. Opinions spread instantly. Panic travels at the speed of light. That makes simple rule-based systems even more valuable, not less. This is where the combination of broad market exposure, dividend growth, and selective innovation becomes powerful. You are not betting on one future. You are participating in many while being paid to wait. The growth component captures upside from technological change. The dividend component stabilizes income and behavior. The broad index anchors everything to the overall economy. Together, they form a system that does not require brilliance to succeed. It requires consistency. Consistency is rare because it is boring. Boring is uncomfortable in a culture addicted to stimulation. But boring is where compounding lives. Another truth that rarely gets discussed is how this approach scales across life stages. Early on, the focus is accumulation. Income is secondary. Reinvestment is automatic. Volatility is opportunity. Later, income becomes utility. Reinvestment becomes optional. Volatility becomes something to manage, not exploit. The same assets serve different roles without requiring reinvention. This continuity is critical. Most people fail financially not because they never had a plan, but because they change plans repeatedly. Each new strategy resets progress. Each pivot introduces error. The best system is one you can live with for decades. That is why he could confidently recommend a simple allocation for his family. Not because it was optimal in every scenario, but because it was robust in most. Robustness beats optimization when the future is unknown. The irony is that this simplicity often produces better results than elaborate strategies designed by committees. Not because those committees lack intelligence, but because they lack alignment. Incentives matter. Asset managers are paid to appear active. Advisors are paid to justify fees. Media is paid to generate attention. None of these incentives align with long-term compounding. Silence does not sell. This is why you must build a system that does not depend on external validation. If your confidence comes from headlines, you will lose it when headlines turn. If your confidence comes from structure, you can ignore the noise. And ignoring noise is not ignorance, it is selectivity. He once remarked that if the stock market closed for 10 years, it wouldn't bother him. That statement sounds flippant until you understand what it implies. It means his focus was on the businesses, not the quotes. Most people do the opposite. They watch prices and ignore businesses. ETFs flip that dynamic. They make you an owner of progress rather than a spectator of fluctuations. This mindset shift is subtle, but it is everything. If Warren Buffett had to start over today, he wouldn't chase individual stocks or iconic brands. Instead, he'd take a simpler, more efficient path, investing in just 3 ETFs and letting compound interest do the heavy lifting. This immediately challenges conventional thinking and sets up a lesson that blends authority, personal experience, and actionable guidance. It transitions into a deep dive into Buffett's formative experiences. From buying his first shares at age 11 to acquiring his first property at 14, he learned critical lessons about patience, staying invested, and valuing real assets over speculation. These stories underscore timeless principles. Markets fluctuate, timing is unreliable, and true wealth comes from ownership and patience, not reactionary trading. The script then introduces ETFs as modern tools that make Buffett's philosophy accessible to the everyday investor. It explains ETFs in simple terms, emphasizing diversification, low fees, and passivity. 3 specific ETFs are highlighted. 1. VO, Vanguard S&P 500 ETF. Broad exposure to America's largest companies, offering stability and long-term growth with minimal fees. 2. SCHD, Schwab U.S. Dividend Equity ETF. Focused on high-quality, dividend-paying companies that provide reliable income and reduce volatility. 3. QQQ, Invesco QQQ Trust. High growth exposure to technology and innovation, providing aggressive upside while acknowledging higher volatility. The script carefully explains why each ETF fits a role in a portfolio, with examples of historical performance, dividend growth, and resilience during crashes. It discusses allocation strategies based on age, risk tolerance, and goals, highlighting how younger investors can tolerate growth-oriented risk, while older investors prioritize income and stability. A significant portion of the script is dedicated to the mathematics of compound interest and the exponential effect of consistent investing over decades. Using concrete numbers, it shows how regular contributions, reinvested dividends, and strategic allocation can turn modest savings into millions, even illustrating the potential impact of option strategies for those who are disciplined. Avoiding emotional trading, understanding the difference between price volatility and actual risk. Resisting the temptation to chase trends or time the market. The critical importance of discipline, patience, and consistency. The narrative repeatedly emphasizes the invisible power of simple, boring strategies, investing in high-quality, diversified assets and letting time do the work. Historical context reinforces this message, showing how disciplined investors survive crashes, take advantage of downturns, and build wealth while others panic or overtrade.
Wealth is framed not as the ultimate goal, but as a tool for independence, choice, and security. By investing patiently in these 3 ETFs, following a consistent plan, and resisting the noise of speculation, anyone can achieve financial independence, retire comfortably, and leave a lasting legacy for future generations.
In short, the script is a comprehensive, timeless guide to wealth building. It combines historical anecdotes, modern investment tools, mathematical proof, behavioral psychology, and practical allocation strategies to give viewers a clear, actionable roadmap for financial success.